Welcome to today's Sasin Sustainability and Entrepreneurship Center Sundowner with Richard J. Smith, Head of Corporate Finance at Tractus Asia. Our topic of the evening is Capitalizing on Opportunity, Realizing Strategic Growth for SMEs and Family Businesses via M&A. Rick has over 25 years of corporate finance experience in Asia and is particularly adept at sell-side deal structuring and transaction. Prior to joining Tractus, he served as the CFO at DWP, a multinational architecture and interior design firm with over 400 employees in 9 countries across Asia and the Middle East. Welcome, Rick, to the event.
Well, thank you, Raphael, and thank you, Sasin and the SEC for having me. Just sound check, can you hear me okay?
We can hear you fine. Yeah, perfect.
Okay, I am going to try to start my screen sharing now. So just please confirm that's working.
Yeah, just in the meantime for the audience, Rick will have a presentation of about 40 minutes, 30 to 40 minutes, giving us some insights on the topic, and then we will open the session to question and answer segment. So please feel free to type in your questions in the Q&A feature of the Zoom webinar or in the comment section on Facebook. We can see your slides perfectly, Rick.
Okay.
I would like to hand over the mic to you.
Great. Well, by way of background, I work for Tractus Asia. For those of you who don't know us, we're a regional management consulting firm. We have about 60 staff in, I think, 8-9 countries in Asia, plus the US. We have 3 practice areas: strategy and implementation. That's usually helping businesses enter the markets here or fix problems. Vendor identification, supplier identification, setup, finding sites. We have a trade and investment practice, which helps governments do trade and investment promotion. And then I had the corporate finance practice, which I've got over 30 years working with companies doing M&A. That's buy side, helping to buy companies, helping to sell companies, helping to raise money, restructure, etc. One of the consistent themes about my 30+ years here has been almost every transaction I've worked on has either been with an owner entrepreneur business on one side of the transaction, not necessarily my customer. And the other element of that is that it's almost always been an international transaction. So probably within a dozen, have aspects of transactions within a dozen markets in the region and the US. So with that, what we're going to do is talk about M&A for, not for the giants, for hopefully, some of you are entrepreneurs or have family businesses, etc. And that's what we're targeting here. We're going to talk about first our view on the regional and Thailand, and more specifically the economy. Unique factors to we're still in the middle of a downturn. Not all the world is, but what's unique about that? What are the implications for M&A? What are strategies for M&A and shareholder valuation, how to improve that? And what might be some opportunities for SMEs and owner-operated businesses? I guess to start with is we're pretty pessimistic on the regional outlook, and even more so on Thailand. You can look at that glass, whether it's half empty or half full, and optimist versus pessimist. I look at it and say it's half full of water and half full of air. So I'm not sure. Hopefully it's not hot air that we're talking about here, but we think we've got a pretty level bead on where things stand. First of all, not surprising, and I'm not going to go into this for great length, but we were hit with a devastating, unprecedented, global, synchronous event, coronavirus. And this slide we've been doing since I think about April last year, and this is about the worst condition we've seen that in. There was more yellow countries or red countries. And of course, Thailand, this has been a disaster where through last year we were in pretty good shape. This is, the whole region is on fire. You're reading this every day in the paper. Thailand's not the only one getting hit. And given some of the regional integration, that isn't great for us as a country or a region, definitely. And rollout of inoculation is just too slow. One of the reasons we're seeing recovery in some of the other markets is they're near this magical 70% line of herd immunity. We're nowhere near that, and that's going to play certainly out throughout the rest of the year is going to be problematic. We also are in the middle of, and I've limited this more to Asia. This is on a global basis of trade and political tensions that aren't going away. And I'm not trying to pick on China here, but if we talk about regionally, they're in the middle of a lot of what we're seeing. The China-U.S. trade war. I'm just going around here on the left. This is the Philippines in the South China Sea about the naval intrusions. We all know what's going on in Hong Kong. The death of hundreds of doctors in Indonesia. The Myanmar military coup. The faltering government in Malaysia. China stepping on its internet giants. And of course, Thailand, the protests that we've seen for the last couple of years. So none of these are, conducive or particularly positive developments for business. I think if we talk to Thailand, about Thailand too specifically, FDI has been an important driver for Thailand's growth historically. That's cratered recently. It's been, it's happened through the region, but Thailand has seen FDI shift increasingly to its neighbors as opposed to here locally, and that doesn't bode very well domestically. And not surprisingly, Thailand has generally been a laggard in terms of GDP growth, in terms of our ASEAN neighbors that we've really considered as competitors. Not a very optimistic picture. The World Bank, when they're looking at projecting how Thailand's going to do, what we were doing was following each of their reports. And if you see there, every report, they're having to revise 2021 downwards. They keep pushing growth back to 2022, but we're still behind the rest of the ASEAN 5 countries, much below that. And I think what they're looking for next year will be driven a lot by a tourism rebound. However, this impact isn't across the board. The Siam Commercial Bank's done this interesting review of what, they're predicting this 1.9% impact of GDP on this last outbreak of COVID and who's been hit the worst. And, not surprisingly, food hasn't been, and health has been minimally hit. Goes down to alcohol, hasn't been hit too bad. And then you start going into clothing and footwear, which people don't need as much when they're not leaving the houses. And then, of course, anything to do with tourism or travel related and retail recreation has just been crushed, between the restaurant and the hotel businesses. So I guess with a quick break there, I don't know if there was any questions. Does anybody think that Thailand's looking great at the moment? I don't see if you had anybody come in on there. So I think if there's an agreement here, we can move on. In terms of M&A, usually we see some sort of correlation between economic downturn and M&A activity, but this cycle globally and what we'll see in the region has been quite different. And I'll explain to what's unique on that. Somebody asked, is the last hope present in exports? Exports certainly would help if, with the bot moving in the right, if it moves in the right direction, tourism will help. Thailand has a broad-based economy. So I think, that's one of its strengths. It feeds itself, but it's got long-term problems, political turmoil, policy, education, and demographics. It's an aging society too, are working against it. So I don't think we're going to see, if you've been around in Thailand a long time, we're not going to see returns to the glory years. Okay, let's try to get this going again. So how is it, one of the things which has been really shocking through all of this is, and you wouldn't have expected when the virus outbreak happened, we were like, put all your money in cash, stick it under your mattress or something. But stock markets kept going up. And even in Thailand, while it's down some, it's still near its all-time highs. And certainly in the US markets, it's still at these all-time highs. And you're wondering, that doesn't make sense. That's counterintuitive. Well, the factor that's driving this primarily is liquidity. Interest rates are at all-time lows. They've picked up a bit, but real interest rates in a lot of cases went negative. That means you were actually paying somebody to hold money in a bank. But this makes the cost of borrowing very low for corporates and homeowners, for example. But it also, and then there's been access to liquidity as well when interest rates are that low. Another factor is corporates. They're absolutely, flush with cash. They're at an all-time low. This almost $6 trillion of cash is sitting on the balance sheets in U.S. companies alone. There's been a slight decline from last year, but not too much. So they've got money to spend. They put that money into dividends. They put that money into reinvestment. They put that money into share buybacks that keep their share prices going up. But they also use that money for M&A. The other interesting thing that's occurred, especially at least in terms of a long-term perspective, is the emergence of private equity as a major player. When we say dry powder, this is how much money private equity players are sitting on that they haven't spent, uncalled capital, and it's close to $3 trillion at the end of last year, and you can see that back to the early 2000s, how much that has grown. And by any measure, in the past 10 years, private equity has basically tripled its size as a player in the markets. Private equity players only do one thing with their cash, is buy companies. So you combine, where the corporates have money to spend on M&A, and private equity is all they're doing is business acquisitions. We've seen a major change in liquidity in the markets in relation to acquisition of shares and companies. Good news here is that Asia has become an increasingly important share of that market, up around figures depending. I've seen that usually is around 20 to 25% in the last few years. So Asia is an increasingly major player. That money is out here for being applied to Asian companies. So if we take this into context of, especially we're in a downturn still in Thailand and much of Asia, even though US and Europe and some of the other markets are recovering, it does offer excellent opportunities. And I would like to explain the general cycle as what you would normally see with M&A in relation to the business cycle, and then talk about what we've seen. So normally you get a peak. That happened at 2019. You have very high multiples. And when I say that, those are price to earnings multiples or price to EBITDA, which is usually used in acquisitions. Very high competition for deals. Everybody believes it's never going to end. Savvy buyers start putting their money, waiting on the sidelines for a downturn. But that's what we saw right at the end of 2019. 2020, the virus starts to hit, and people who are in the middle of deals start trying to close them. They're renegotiating them. Pricing starts to fall. And this would be typical in a process. And that's what we saw in Q1. As the recession becomes clear, markets tend to freeze up. And in Q2 2000, they absolutely froze to almost their lowest in ages. Sellers are still thinking about peak prices. Buyers want visibility on business performance and when the turnaround is going to happen. And especially with the case of COVID, we didn't know who were going to be the winners or losers. You maybe start to see some distressed deals, but Q2, really was last year was, we couldn't even talk to people about M&A at that part of, as a viable something you should be spending your money on, because there was no visibility. And then usually as you get towards the end of the recession, multiples drop by 25 to 50% from their peak. Businesses' earnings have gone down, so that even compounds the effect on valuation. So a business over a period of this will often lose 50% or more, of its valuation is easy. And, we had the question mark, is this happening in 20 or 22, 21 or 22? And then you start your recovery and this deal velocity picks up, and over time, all this stuff increases. And, the average, the time frame usually for a recession is 6 to 24 months, and you get recovery in 5 to 10 years. What's interesting here is this decline in multiples that we would see typically in other time frames has not happened. What we had was you see that circle there. Q2 was a crash, but look at the rapid rebound in M&A activity and deals value. This was, it just absolutely bounced right back. Very unusual. And like I said, Q2, you'd have to go back almost, 15, 18 years to get to levels that were that low previously. And now we're back to all-time highs. What's driving this? Certainly, anytime you have a downturn, companies start to rationalize their businesses and you start seeing spin-offs of or divestitures of non-core businesses. So, there's a lot of sell-side activity going on as a result of that, but liquidity is what's driving this. And a lot of that, not just the corporate liquidity, but the private equity players. And private equity players, you got to realize, is they raise money for a fund. Then they have to put that, and they've got a 5 to 8 year period where they're trying to invest in and harvest that money. And about 4 years or 5 years into that, they go out and start trying to get raising money for their next fund. If they haven't invested that money, they don't get the next fund after that. So they are, once they've got that fund raised, they are under pressure to put that money to work. And given the size of that they are in the market, you hear they're doing bigger and bigger deals, and they're a more and more important player. I think we saw that they were 25% of the mid-market deals that were being done in Asia. That may be global, I'm not sure. Southeast Asia is an active market. BDO's published something interesting, and the number of deals reported, I believe, is what are under negotiation. Actually, transactions are closing. But I think what's really interesting here is this isn't limited to just a hot sector or two. This is pretty much across the board, especially if you look at how broad industrial and chemicals are defined. This is happening across all types of industries. So you don't, and the ones that are getting punished are leisure and real estate, I think, where we would have seen more of that perhaps. But given where we are in the cycle, I think there's going to be a lot of distressed deals in that later on. Any questions there on a break before we talk about, that? I think that kind of wraps up what's happening right now in M&A and why this liquidity is driving the fast rebound. I'll talk about strategies next. Nice. Okay. So, I'm sure any of you who are in, working in a company or looking at your own business last year, come around February, March, April, panic was set in, and everybody was looking at how to cut costs, how to maintain business, protect the business, try to keep employees, etc. Contingency planning to the extreme. Now that we know how COVID's, and this has actually been, maybe the last 9 months, maybe even a bit more, now that they know how COVID's affecting them, now they're turning their attention to growth initiatives. The fundamental premise of what I'm talking about here is that if you agree that we're in slow growth markets, and Thailand is one of those, organic growth is incredibly hard because it means you have to take business away from a competitor. Very difficult. When markets are growing at 10, 15%, it's really easy to grow because the whole pie is getting bigger. But when you're having to take something away from a competitor, that's very tough. Eats into your profits. It makes it much tougher sell. So, you know, in today's environment, growth is going to be driven by M&A. And if you are not part of that, and you're not in a market that offers high growth, or you're an extraordinary player who is managing organic growth somehow, you will. It's not only important that if you're not doing it in terms of how you're limiting your growth, your competitors are and will become more competitive and a more threatening force. So then you ask yourself, am I a buyer or seller in these markets? And interestingly enough, and somewhat counterintuitive maybe, is that the downturns provide opportunities on both buy and sell side, not necessarily to the same groups of companies. But BCG did a really interesting study on, they looked at over 50,000 deals over 40 years. And they had a metric called relative total shareholder returns. So these are returns above normal shareholder returns. I'm not going to go into the detail or even pretend that I know the technical aspects of that, but what they found was companies that did acquisitions during weak economies on average almost a 10% superior return over companies who didn't pursue those acquisitions. Okay, that's kind of easy to understand. You buy low, to sell high, and so when you're buying in a weaker economy, you're buying in ideally at a better price, and it's a good time to hunt. The one that's not so intuitive is that companies that have sold during downturns also yield superior returns, not as high, but they had a 3% one-year improvement. And I think the reason on that is what we were seeing is probably divestments, where companies are selling non-core assets and they're taking those funds to focus on, their core businesses or higher growth markets or opportunities. So it's interesting as down market trades on both sides seem to yield positive benefits for both buyers and sellers. Now, I would like to say, while we've been talking about the business cycle and the M&A cycle, I would like to make a big caveat is I'm not a big believer in promoting timing or trying to time your exits. We've had lots of people, every time we have somebody say next year or in 2 years, we're going to be ready, something happens. A black swan happens about every 2 years if you look on the average of this chart here. And the bottom are some of the global ones, and the top of that graph is what we've seen here in Thailand. So you need to think of this more as in terms of long-term strategic, long-term strategy, and don't think that you can really prognosticate or see what the future is going to be. So we have two frameworks that I'm going to talk about in terms of looking at your strategy. One is offensive versus defensive. And defensive strategies are strategies that you use to protect or bolster your position, and offensive strategies, generally we talk about, are growth oriented. So on the defensive side, you try to get better capacity utilization, leverage your distribution or sourcing networks, find administrative back office efficiencies or synergies. And one that I particularly like is if you combine with a competitor, you can take out some price competition, hopefully get some pricing power. On the offensive side, you're looking for new products, new geographic markets, new customers, new assets or capabilities such as technology or service skills, etc. We also have, the opportunities are also for domestic versus international approaches. And, there's some of a mix, this isn't all the same with defensive versus offensive. I mean, domestic, again, it gives you a chance. We often see these to utilize capacity more efficiently, administrative efficiencies, reduce competition. And then there's another thing, what we're seeing is monetize assets. When you combine two companies, often there's excess assets that don't need to be employed at that time. And you could sell those off and monetize those in a deal. Internationally, the advantages in our company's example of that, DWP, where I was on the board, we were in 7 or 8 countries, is you get reduced volatility. When one market's up, another one's down. So that's a big advantage. A lot of times, if you try organic growth in a market, if you haven't hired that right person or the right group of people, you make a lot of mistakes. But by doing an acquisition, you've got a proven management team right in place. The downside to international is it's administratively way more complex. You have to be familiar with international regulations, taxation, and we found you add about another, if your admin expenses are running 5% of revenue, you're going to add 0.75 to 1.5 to that for each country that you go into as a smaller company. So, and I think the other thing on that too is management time. I think a lot of us have learned during this, with like what we're doing today, is that travel time really sucks up a lot of management resource and energy. And at a senior level, when you're trying to manage an international business, I think that's underestimated a lot. So I think that's part of that administrative complexity, administrative cost element that we see when we're talking international approaches. Now, I have previously done a talk at the SEC on selling a business and valuation approaches and the process, et cetera. I'm not going to go into a lot of detail on that, but just I'm going to set this here as a framework. It's got 3 major phases. If you're doing a formal process, there's a preparation phase. And if you're the seller, you're identifying your business strengths, what you want to do. You put together a business plan and information memorandum. You identify who are potential buyers. And on the buy side, you're saying, okay, what are my objectives? What are potential targets, and what am I looking to get out of this? The middle stage is outreach and marketing, and that's contacting the counterparty, doing some initial information sharing. You get to a letter of intent or an MOI or a term sheet, and then you go into what was normally is an exclusive a period of where you're doing negotiations, structuring the detailed due diligence, doing contracts, and if you're lucky, getting to close it. 80–90% of this business this happens in phase 3, and that's also where most deals fail. But I'm not going to go into that right now, but just wanted to lay out the process. So what about SME businesses? This is, this sounds daunting. The headlines are with these these mega deals we've been seeing. SMEs don't need to be bystanders or targets in this, in using this as a strategy. Sorry. So, what about the SME market? Well, one of the things is we've been seeing are people that are gray-haired about my age, of owner-operators without succession options. They've sent their kids to med school or lawyers, and they don't want to come back and run a garment factory or a machine shop. At this age of life, this is you'd be starting to look for an exit, and a lot of ones that we've seen are pretty, decent, profitable businesses, but if they're in, being in Thailand, they often are low growth and dependent on a few limited, often long-term but good customers. The other thing we're seeing, and those of you who are, certainly in Bangkok area, a factor, if you started on the outskirts of Bangkok or even in Bangkok and had built a factory or an office 20, 30, 40, 50 years ago, these family businesses, often now the value of the land in these factories often exceed the value of the underlying business. And some of these assets are idle or underutilized. Valuation, people start thinking of the heyday when, stock market multiples, you could easily think of 10 times earnings and stuff. Those days are gone. And, business that isn't growing is, a rule of thumb trades at 3 or 4 times of EBITDA. So that's not really necessarily very appealing. And somebody at my age doesn't, they may not have the cash, experience, or risk appetite to start pursuing acquisitions at this stage. And all those are fair things. So what's, and when you think about this, we want to talk about, about some of the factors that affect firm value. Now, revenue and size are definitely important. Bigger is better. There's no question about that. More profitable firms are worth more. Firms that generate cash flow are worth more. High growth firms are worth more than low growth firms. Track record is extremely important. And that's mainly because it goes to credibility on projections. If you've been growing at 5% a year and you tell people that's what you're projecting in the next 5 years, you're credible. If you say, I'm going to grow, I've been doing that for the last 10 years, but now I'm going to grow at 15%, that may be problematic. Reliability of revenue stream, having long-term contracts, et cetera, or just showing that you had customers that are repeat customers over a long period of time. Continuity of management is important. A more diversified customer base is definitely important. I've had clients that have had very good businesses. They look financially good, but they've been dependent on 2, 3, 4, 5 key clients for over half their business, and that punishes valuation. Of course, macroeconomic and industry outlook are important. Barriers to entry, whether those are technical, contractual, skill set wise, are important. And then one that a lot of people don't realize is having strong corporate governance and financial controls and reporting are really important. I did a talk with Navis, which is a private equity group here regionally a few years ago, and they assign a 25% value premium to firms that already have this in place because they don't have to put this in place, and it is worth that when you go for their exit subsequently. So I think that was pretty interesting. But these are some key factors that affect firm value. So when you're thinking about M&A, you need to think about these in this context as how will these lead to better firm value. And one of the things you have, if you're one of these people that I just talked about and you don't have money or you don't want to spend the money, is you should be looking at non-cash deals. Those are what we would call mergers, combining 2 companies together. And DWP, where I was a CFO and was on the board for quite some time, we were actually formed out of a merger of 4 companies, and we had done a couple subsequent to that. It increased the size of the business substantially. The benefits are and if you look at these factors here, no need for cash. You're immediately a larger company. You could be reducing price competition. You could be increasing your customer base. There might be some economies of scale. You access a broader management team. And if you do it right, you put in a shareholders agreement with corporate governance. Those factors are all things that we just talked about that enhance shareholder value. You may end up with idle assets that aren't needed once you combine the 2 business, and you can sell those off and monetize those. Financially define the SME. Fair enough question. The BDO used $500 to $500 million as a deal size. In Asia, I would say generally in the market that we're talking about is, I would say companies up to, maybe 200 million in revenue. The small size, if you're under $1 million in EBITDA or something, you're in the smaller size, and I'll show you what this means. The definition isn't hard and fast. But I'm sorry that I didn't address that earlier. So, when you look back to the slide that I showed earlier of the factors that you can improve firm value by merging a business, it's a pretty substantial proportion of those, what we call the key value drivers. So it should be definitely considered. And size is a really big driver here. Here's Pepperdine does a survey every year on capital markets and on private companies. And EBITDA, for those of you who don't know, is earnings before interest, tax, depreciation, and amortization. And it's generally, people look at multiples of that in transacting companies as the standard measure of a deal price. Now, what's interesting here is if you look at how much, the multiple increases as the EBITDA increases. So if you were to take 5 companies that were earning $1 million EBITDA, the average multiple is 3.3 times that. You combine those 5 companies with no other change, just by getting EBITDA to 5 million, you've gone up to a 4.8 multiple. That's a 45% increase. Once you take that to 10 million in EBITDA, that's a 26 or 28% increase. But the importance of size in relation to EBITDA multiples is driven by bigger businesses are generally more diverse and less risky. And in the context of corporate buyers and PE funds, which have generally got more and more cash, they want bigger companies to invest in. And if you look at this, the question is, do you want to let somebody else buy you at 3.3 and extract that additional value by virtue of size, or do you want to work with your competitors or somebody in another country to grow that business and extract that premium multiple before you put a company up for sale? So, this sounds easy, but doing these M&A deals aren't without their challenges. The things we see, typically in owner-operated businesses is they're highly dependent on the owner-entrepreneur. A lot of times we see them mixing personal and business accounts, but that's usually addressable. They have a strong emotional attachment to the business, so you're not just talking about a deal, you're talking about their life's work, so that's really important. We do see very unrealistic expectations on valuations typically. The accounting, financial control is generally not as good, though that's improved over the past 10 years, I think, with a younger generation and more tax regulation. And creative and aggressive tax planning. That's tax cheating. And that is a problematic area, and that causes problems in the area of divergence in valuation, which I'm not going to go into right now. What we see in corporates is, and a lot of times this will be on the other side of a transaction, is they are professionally managed. They have more sophisticated systems, financial reporting, legal structures. Sure, of course they can afford it, but they are overconfident. Anytime we've seen somebody new come into the country, we can see, yeah, we can do it. It's easier, faster. We're going to build this and be up and operating and profitable in a year. They're risk adverse, or cover your rear end, so to speak. They're bureaucratic. They're subject to change. They have a bad quarter. There's a change in a manager, so they change their mind. And somewhat tied to what's above is they don't know what they don't know. They think about things in terms of their home markets, and they don't even know what questions or areas that they don't know about. And so we often see mistakes in that area. Southeast Asia has some additional structuring challenges. There are foreign ownership restrictions in most markets, and that applies to corporates. And it also applies to land ownership. So the ability to do those structures and the complexity varies by market. Taxation is often not transaction friendly, and that's certainly the case in Thailand, where you try to do asset split-offs, mergers, spin-offs, all types of reorganizations are often too costly or aren't even available under the law. If you're in sectors like logistics, distribution, or hotel, where you often have real estate assets and operating assets as separate businesses, that makes that more complex as well. And then if we're dealing with smaller deal sizes, transaction costs become a higher percentage of the deal. They're not less necessarily complicated. Optimal deal structuring still takes the same type of qualified accounting and legal and financial advice. So you're talking about a higher percentage of the deal than you would on a big transaction. I think the biggest challenges for the SME merger deals when we've seen this is one is leadership. Thailand is one of the most entrepreneurial countries in the world. The independence and the success and the creativity as SMEs and owner-operated businesses contribute a huge percentage to this economy. But they like to be their own bosses, and they're used to. And when you do a merger, you're going to need a business leader, in most cases, a leader. And I think the personal letting go of that and making that work on a personal level is probably the very challenging. You do have to agree on valuation, though these are relative valuations. So it's not like I'm buying and you're selling. You just have to say, what percent is my firm versus yours? And so we see that actually as an easier element. But then what to do with non-performing assets that you're able to sell off or something? Who gets the benefit? Do you do that before or after the deal, or leave that with somebody? That's a complicating factor. Structuring is complex. That's and often the companies haven't prepared themselves for subsequent transactions. So that we see as a problem. And then you do have to spend money before you get to a deal, and people in Asia, emerging Asia, especially, are hesitant to spend money on advisory and consultants and legal fees like that. So we find that a challenge as well. So I think that's a wrap up. We'll take questions. I mean, just in summary, we've certainly had the worst economy ever. We are turning the corner in some markets. Even if we're with COVID for good, we're going to be, we'll turn the corner. But I think we're facing low growth over the next short to midterm. Lots of money out there, people looking to do deals. The M&A, that's not actually is rebounding ahead of the economy. It has rebounded ahead of the economy. There are opportunities as both buyers and sellers, and we think SMEs in particular, if you're not a buyer in that case, certainly you should be looking at non-cash merger type deals. Thank you. So,
hi, thank you, Rick, for this great insight presentation. And I would like to ask the audience, please participate and join us via the Q&A feature to pose questions and deep dive a little bit more into the topic. Maybe you have a company already in mind or your own, and you would like to know more about the sector. That's your chance to engage with us directly and get Rick's insight on the topic. Maybe do you mind? So I have a couple of questions already from I would like to ask. In the meantime, maybe let me just quickly check on Facebook. We also have no question there, so let's go away. Okay, we as the Sustainability and Entrepreneurship Center at Sasin are always keen to learn where sustainability considerations play a role in business, right? So therefore, I'd like to ask you, where in your transaction experience did you see this topic being of concern? How would you see the topic's relevance, for example, as a mid to long-term risk mitigation factor play out?
If you asked me this 2 years ago, or maybe even a year ago, and I think maybe somebody might have even asked that last time I spoke, the answer would have been it was a check the box kind of thing. Yeah, we've looked at this, right? Yeah, it was, in terms of the process. Everybody now addresses it in their information memorandums and stuff. But I think there's been a definite change in the last 2, 3, 4 years on this. I've had worked on transactions in the transportation freight forwarding sector. I'm working one that's related to oil and gas. And this is no longer just a question of check the box. involvement of activist investors, I think, has taken a role. People being younger and caring about the world they live in, maybe in older people as well. But in the private equity side, for example, because our client was related to oil and gas, they're limited partners. The investors and the funds just say you can't go near it, straight out. And if they're not precluded from it, they need a green strategy. How are you migrating from fossil fuels into green energy? In freight forwarding, which was our client was mostly for air freight, which is an issue is how do you, what are you doing to mitigate that? So I would say that this has gone from being merely a check the box to a serious question of buyers. I would say there's still some of it of the element is dressing, but I think it's becoming increasingly important for those reasons that I've just said.
Yeah, thank you. Thank you very much. It's good to see from our side. We always love to see that sustainability becomes more an integral part of business rather than a cost factor. And as such, maybe even a benefit or future revenue generator in terms of competition or segmentation of market before presence. So another question I had is, and this is something based upon conversations I had with colleagues and friends which are in family businesses, that succession. You mentioned succession as a factor. How would you think of succession and the relationship to M&A, especially in those critical situations we are in right now?
Well, if you're a seller, you're going, well, let's start first. If you're just an owner, you have to have succession if you're staying in. And that's often a challenge in a smaller size business. If you're a seller, you're going to have to stay in for a period of time until a buyer has a chance to replace you. In a merger type, deal, that's, one of the advantages, perhaps, one of the players in that does have somebody in the family who's younger who wants to stay along. You have a broader management pool. You're a bigger company, so you may be able to hire somebody more effectively. So I think that a merged business provides, and a bigger business provides more opportunities for succession.
Okay, thank you very much. We have a question from Greg in the chat. He asks, in the sale of a business, can you give us an idea how the marketing of the sale looks or works? And does Tractus get involved with that?
Well, we certainly do. And the marketing of the business is, it's preparation of an information memorandum and what we call as a teaser. We call them snapshots, but they're teasers, financial modeling. The important thing, a lot of this is being prepared up front on how to present your business, and also actually being that your business is actually prepared, that you have your accounting and finance in order and all these other elements. Once you go out to that, then you have to identify buyers, and that's through that's research, internet research. There's services you can subscribe to. And then, then the process, you reach out through a teaser, it's usually anonymous, and then you try to solicit interest. If they're interested in that, you move them to a non-disclosure agreement before you provide them with the information memorandum, typically. And based on that and some information sharing, you try to get them into a term sheet stage. So in that marketing stage, it's identifying and contacting the buyers, providing them with a teaser document, getting them under an NDA, providing them an information memorandum and additional information, enough to get them to an interest level to make an offer or a preliminary offer on the business.
Thank you very much for that answer. We have another question from Motoki. When buying a company, how does presence of competitors of the company being purchased affect the decision-making process for the buyer of the M&A? Particularly in the case of an SME, with their limited company size, there are numerous competitors and their presence is not considered significant. Do you make M&A decisions based on the assumption that you have special resources or competitive advantages?
So if you're the buyer, I mean, there's good and negative aspects to having multiple choices. One is that you have multiple choices and more negotiating leverage. The negative of that is that you've got too many choices, and maybe you think you got too much leverage, and you're not getting to yourself to a deal. And maybe the roll-up play is to be doing multiple acquisitions as opposed to one. If you don't get to a deal, you don't get that roll-up. So certainly, I've had a deal, when we were looking at freight forwarding was interesting. It's a highly fragmented industry, which means it's ripe for roll-up. But it's when somebody like a PE buyer is looking at that as they're saying, okay, but who's my buyer? In a fragmented industry, there's multiple companies still available for sale, so I have less leverage. Whereas if I'm on a more oligopolistic market where there's 2 or 3 players dominate, and then there's a handful of players underneath that, there's obvious buyers who are going to want to consolidate. So certainly as a buyer, having more options is a negotiating advantage, but you shouldn't, getting to a deal that, if you don't get to a deal, it's no advantage at all. I hope that's answered the question.
Mm-hmm. Thank you. I would like to follow up with the question is, what if your company is not in the position to be a leader in a transaction? What would be your advice to position yourself for an approach from an outside entity?
Well, I mean, I don't know if there's such a thing. Wait back, wait and see is a rough place to be in. So, I mean, I think the first thing is good companies will always have interest. If you're not in a position really to be a leader or something, then, usually who your competitors are, or people in adjacent spaces who might be of interest. I mean, those are somebody you can talk to. I mean, you can go out and hire somebody to help you with this process, which is what we do. But, I've had people who have had, smaller businesses, and I'm not talking tiny, but, they're a few $1 million size, they're decent profits, but, who your competitors are. They're, in some cases, you may even be friendly in that. That's often a place to discuss, have that conversation and say, I'm interested in either exiting, or maybe if you ever thought about merging, would be interested in doing that. But I mean, having a good business first is always the best position to be in. But I think just sitting by and hoping something comes your way is it's probably not the way you approach your business, and it's probably not the way you should approach a sale either.
Yeah, my thinking was also like, do your homework, basically, what you mentioned.
Well, when I do my other talk on this, when we talk about this, is if you consider that the sale of your business is probably worth, a half a year, 2 years of revenue, it's the most important sale you make in your life. It ought to have that, you ought to put that type of consideration behind it and effort behind it.
That's a great way of putting it. For the audience, I pasted the link to the past event in the chat box, and on Facebook, it's also in the comments. So please feel free to check that out. There are also the slides and the recording available. So Rick is deep diving on that one into what are the processes of selling your business or startup. We have a question from Eugene. He asks, is an earnout still commonly used in an acquisition of an SME? And if yes, if that is the case, what is the common ratio?
Yes, it is very common in deals because of the dependence on the owner entrepreneur, and often the dependence on a few, they often tend to be risky. It might be customer relationships or something like that. There isn't a common ratio on an earnout. Any way you can imagine a deal structured, it has been. Somebody might pay you 3 times now and another 1 times after 2 years. When we work with clients, we try to structure so on an earnout, it gets the upside if the guy delivers, and guy or gal, whoever, if the seller manager delivers, that they get that up, or over delivers, they get upside to that. But I don't think there's not a standard magical number on that.
Great. So yeah, we have another question from Greg, who asks, in the sale of a $1 to $5 million revenue and profitable SME, how important is the lack of and the notion of that lack of depth, and the notion that the property is rented or nimble?
Well, that goes to a different the valuation lecture. How debt is the difference between the share value and the enterprise value is that's actually the difference with cash and debt. So in terms of the share owner, if you have no debt, that means that there's no deductions against what the core value of the business would be. Depending on the business, not owning your property can or may not be advantage. I think in larger manufacturing businesses that are specialized, it's important, right? But on the other hand, is if you're in small mobile businesses where you're not tied to high rent districts or high rent areas, that can be that's an advantage. And especially, like I said, I was seeing, especially people if they're in properties that they've owned for a long time, those properties are worth so much now, and, relative to the businesses, and then to split those off, you have to move somewhere else first to extract the value of the business. It's a tougher, or sell off the property and hold it and rent, agree to rent it to the new buyer for a period of time at a reasonable rate. So those are tough decisions and complicate transactions.
Thank you. I would like to loop back a little bit to something you showed in your talk, which was the different growth rates of the economy, or expected growth rates of the economies in ASEAN and Thailand specifically versus globally as well. And my question is, can you give us your thoughts on cross-border M&A attempts versus local market opportunities, and who and what segment does traditionally benefit from each of them?
I don't think, on that one, I don't think it's necessarily one or the other. I think you have to look at your circumstances. I would say that, if you're one of a few key suppliers in an industry, so, I'll give you an example of a company we talked to who was there was maybe 10 players locally in the industry. It tends to be a domestic industry. It's resource-based. It's in minerals. And there was, 2 or 3 top players, and then a few other smaller ones. To me, that's a domestic play where you aggregate the bigger players and try to get market power and market share. On other ones, where there may not be the advantages of aggregating. Let's say you're you have a software that you distribute, or medical equipment or something that you distribute, maybe linking up with that same distributor in 3 or 4 markets, of the same products in those markets, may make more sense. I don't think there's a clear answer on that. I do think that some of these people are more open to international stuff just because they don't have the competitive and face issues that you see necessarily in Thai. Thais have traditionally not sold companies. If you look at where they are versus a lot of the neighbors, they've been way behind that. And part of that is from the top companies on down, there was always been a face issue of selling your company as a loss, as a submission of failure or something. China got over that much faster. Vietnam's gotten over that much faster. Singapore is, most of the mid-market deals are in Singapore and Malaysia right now. So, I think I like bolstering your domestic position as a general thing. These are people, it's a peer group, you kind of understand each other, you went through that same period together. So I think domestic stuff's overlooked. Whereas internationally, people like having that one step access to a new market.
Mhm.
So, you know, it depends on your objectives.
Yeah, maybe to follow up on that statement, domestic aspect of it. Do you have any predictions for the Thai market in terms of sector activity in the short and midterm?
I mean, I think if you looked at that graph I showed us, I think that showed, you know, the Siam Commercial Bank was pretty good. You know, basic material, you know, basics are going to still do solid. Healthcare is going to do solid. You know, Thailand, we do have good medical care here relative to, you know, in the region overall. Logistics, I think, is going to be a big area that's going to benefit. You know, but it's very competitive. That's the, you know, the market's growing. But, you know, all the delivery stuff is a growing market. The question is who's going to come out of this profitable? Cold logistics is a big area. Thailand is very low relative to regional or global percentage of spend on cold storage. So I think those are areas that I'm familiar with. You know, but you know, the benefit here is this is a broad-based economy. And it'll do okay, but you know, unless you're, you know, those are the obvious high growth areas, everything else is going to be challenging. You know, some specific firms with technology may be winners, but you're going to be in a mid-term, long-term slow growth market. We're an aging country, so we don't have the young labor force anymore. The education system has largely failed. You know, it's a middle market, the middle income trap. It's very hard to get out of. Very few countries have succeeded at that. Thailand, isn't going to succeed at that. With political instability and some other factors, you know, if we look at hotel and tourism, that will recover. We're going to see. I think we'll see. Eventually, you know, I mean, maybe it'll even help improve. Maybe we'll stop some of the overbuilding. We're going to see a lot of distressed assets and transactions. I think business travel has been forever changed by this because we now realize we can do so much via Zoom. So the hoteliers I know with the multinationals and stuff are saying that they'll never see a full recovery in the business travel.
Thank you. Yeah.
Value-added food, I think, is an area that'll be good. You know, is another one. Going to basics where you can do value-added processing technology.
Mm-hmm. So let's try to sum it up a little bit because
we did have one question on here that you may have missed that I just wanted. It's okay. It was, I think, from Pradeep. It said if the company is in a distressed asset workout situation, how should a buyer and seller approach it? I did the very first CDRAC restructuring years and years ago. Distressed deals are really tough, and I think the hardest part of that is you know, is on the seller side. Is you're largely in trouble, and seeing, you know, and my experience has been is the sellers always overestimate the value of the, you know, what they have until it's too late to salvage anything, and the buyers are they're sharks, and they're you know, and that's what they're you know, and they realize that, and so I think I don't like doing workouts because I like most deals you can do are win-win. Those are very tough ones.
Thank you. Yeah, let's maybe for closing words, let's bring it back a little bit to the topic of today's evening with the family business and SME focus. What would be words of advice, or what things would you give people on their path towards considering M&A as a strategic growth opportunity, especially maybe if you talk generational differences with older business leaders and younger future managers or so?
Yeah, put this in your mental roadmap, you know, option as part of that. Consider mergers as an opportunity to extract value prior to a total exit. Because if you don't extract that, then the next party will do that. It's almost, there's a giveaway there in a sense. I mean, there's risk and hard work as part of that. Don't do this willy-nilly. The mistakes you could make on structuring and tax can be catastrophic and make this stuff all not worthwhile. There's don't, I'm not trying to plug ourselves, but you do need legal, tax, and structuring advice on this that's appropriate. And it's harder. It's harder to swallow for smaller companies, but you need that same level of professional approach to this in order to maximize your value.
Awesome. Great. Thank you very much. Yeah, I would like to close the event with that. Thank you very much, Rick, for your time, your presentation, and your valuable insights into the segment. Much appreciated.
Well, thank you for having me. I very much appreciate that. And what we'll do is I'll send if anybody wants to contact me, we can make that presentation PDF available. I'll also send that to you as well, Raphael. So we're happy to share that, and feel free to contact us with any questions.